are, we've skipped some steps, or we kind of need to make sure we've got some more understanding. So today we are going to talk about balance sheets, and I'm going to try to keep this fairly basic. We're going to go into lots of different parts of the balance sheet, but I want to make sure that we leave with a real solid foundation of the fundamentals. And if we don't leave with that today, or we don't finish with that today, I want you to let me know, because that's the goal. And that's what we're really trying to get back to, is make sure more than anything, everybody understands the fundamentals. Because I think if we don't have that part, we aren't helping people as much as we should. One thing that's popped out really clearly in our 2024 data, we have a number of customers that came back to ranching generally, and I have a number of friends that ranch that have really strong backgrounds in finance. And they tend to be amongst our most profitable customers. We have obviously customers of ours, but we can also think of examples of this who are fairly public. If you listen to podcasts, you know that there are guys like John Maddox and Logan Pribino running around in the world, and they are very successful ranchers. They're not rich guys who came back to the ranch, right? These are people that grew up on ranches, went off and pursued other careers, and then came back to the ranch. The coolest thing is they bring the skills that they learned while they were away and now combine them with the skills that they learned while they were on the ranch. And we're seeing the sort of way it looks in our data is that often those guys kind of have an unfair advantage. And I am developing the opinion that the unfair advantage really is the fact that they have really in-depth knowledge of finance and how it works, and they are able to really apply it well in their business. So that's the unfair advantage I would like to convey to all of you guys, if at all possible. And that's what we're going to try to do as we're going forward with our webinar. So if you have any questions or comments about that, I'd love to take them. And then we're going to jump here into a presentation. So what do you think? Taylor, any thoughts or comments?
No, I think you hit the nail on the head. I know you and I were talking about this, that Chase Young guy, the legacy farmer, and they say the fact that to be in the top 1% of farmers and ranchers, all you have to have is a current cash flow balance sheet, and you're in your financials, and that puts you in a great position with your bank. So I agree with your statement.
Yeah, and that's kind of a weird statement, isn't it? Where it's like, man, why is that so important? And so one of the things I've been also trying to clarify is that when people come to us as customers, and obviously there are people on this webinar that are customers and non-customers, these are open to the public, but we have two different types. And one type of customer is looking to offload what I think of as the Whitby bookkeeping work. And the other is trying to offload the Whatby work. And I think trying to offload the Whatby work is a very bad idea. We can assist with Whatby work. We can be part of that discussion, but we really don't get to offload the responsibility for results in our business, which is ultimately what Whatby work is about. So, all right, with that, I need to move a few things around. I can't seem to disable the waiting room, so I don't know how that works. I'm going to start sharing my screen, I hope. Screen 2. All right, you should be able to see a slide that's Kiyosaki's model of financials. Everybody see that?
Looks good.
Good. And Stan, I think you should have named your phone iPhoneistan, not iPhone Stan. I think it would be better represented as Eastern Bloc country than anyway, all right.
That's
so
a
here we
default.
go. Say it again.
That's a default. I didn't do that.
I'm sure it is, but man, if you changed one letter on that default, it would be funnier. So you'll have to figure out how to do that.
I'm one letter away from Satan or Stain.
That works.
Yeah.
Just so you all know, I want us to watch as Stan is driving around. It appears he's still now, but I want you to notice if he's heavy on the brakes or if he's knows how to slow down. He tends to go through brake pads way faster than he ought to.
That's not me.
Oh, sure, sure. Yeah, blame it on the employees. That's how it always works. Very good. All right, well, let's jump into this. Most of you have seen this model. There are going to be a few things in here that I think are review for lots of you. Please stop me at any point with questions. Again, the intention here is we are reviewing things, but with the idea of then making them more effective as we go forward. So Kiyosaki has this wonderful model of financials that I really love. And the reason I love it is because it's very functional and it gives us a way to think about how our businesses are structured, how our personal lives are structured, our personal financial life, if you will, how money works. This is a place where you can criticize Kiyosaki if you want. I'm not going to say any of these ideas are perfect. But there are a bunch of things in here that become very operational and very helpful. One of the things that he focuses on a lot, and this is not important for this diagram, but he focuses on the fact that for an asset to be a real asset, it has to put money in your pocket. And most of us lose focus on that and wind up owning things that the bank thinks of as assets, but which don't actually put money in our pocket. But when we think about how money flows through our financials and through our life, I think we can start to make good sense of this. So our profit and loss is made up primarily of two categories. The top part of your profit and loss is income or revenue, money coming in. The bottom part is money going out. And I want to make sure everybody absolutely understands that this expense category here is money that leaves the business never to return. Okay. The expenses are you buy, this can be direct costs, overhead costs, interest, whatever. But when I pay money, when I pay interest, that money that was mine leaves the business, becomes someone else's, and does not come back. P&Ls also involve income, which is money that comes in from somewhere else. So in a P&L, there is a lot of flow into the P&L in the top and out through the bottom. And I really want to make sure everybody understands that and has kind of a visceral feel for it. The balance sheet, on the other hand, our second, I think of it's the second financial report we're going to talk about here, but in the grand scheme of things, probably the third most important financial report, if you will. Cash flow being number one, P&L probably being second, balance sheet being number third, but we can debate P&L and balance sheet, whether they should be second or third. But a balance sheet is made up of assets, which are things you own, and liabilities, which is, what you owe. Most of the time, we are paying for assets with liabilities. And it is very, very important that we are matching our assets and liabilities by type. So if we're buying a short-term asset, we are matching that. If we're financing it, we're matching that to a short-term liability. If we're buying a long-term asset, we're matching that to a long-term asset. So we're going to have a quick quiz here. I would like an example, and you'll have to shut your microphones off for a second to be able to do this. I would like an example of an expense, please. What is an expense in your business? Don't all jump at once. It'll be okay. I won't bite you. I might yell at you, but probably not. Who can come up with an example of an expense? Abe, I know you can think of one. Your microphone looks like it's off.
Bulls.
Bulls. Okay, you go and buy bulls, right? Awesome. Good. Great example. What else? What's an example of an expense in your business?
Feed.
Feed. Very good. Awesome. Give me one or two more.
Don, people are answering in the chat.
Oh, well, that's good to know.
Fuel.
You make me look at too many things at one time. Fuel? Who said that? That's awesome.
Me, Jennifer.
Jennifer, good. Okay. Dishwasher soap. Yes, Monica, a big one in your life, right? Okay. And then we also have fence and side by side. I'm going to put those to the side for just a moment. Let's say portable electric fence, polywire. That would be a great example of an expense. Let's put that side by side to the side, if that's all right, for just a moment. Good. What else? Utilities, yeah. Electricity, phone bills, all that stuff. Okay, great. What are some examples of liabilities?
Pickup trucks.
The pickup itself?
Sure.
In the Kiyosaki model.
I guess that would go on assets.
Aha. Okay. In a traditional model, that's going to go in assets. So when you submit your balance sheet to your bank, the pickup is going to be an asset. The loan on the pickup, though, is going to be a liability, very clearly, right? In all worlds. Okay. If you're Kiyosaki, that truck goes into the liabilities side or not into the assets column. So
yeah,
we're not going to be too pure about that. Bill Barnes, line of credit. That's exactly right. Bonnie Downing, any of the loans you have. Tractor loans, four-wheeler loans, motorcycle loans, cattle loans, loans for capital items, etc. Good. What are some examples of assets on a traditional balance sheet? So we'll use your bank's definition, not just Kiyosaki's. Land would be a great one, George. What else? Livestock. Very good. A tractor. Perfect. Okay, everybody understands those? We didn't do income. Do we all know what income is? What is income? Oh, I must.
Money coming in.
Yeah, from the sale of whatever, right? There, it can come in for services. It can come in for products. It can come in for lots of things. Okay. Good. Now, I'm going to jump forward here. Let's see if I can make this thing advance. Hang on a second. How do I do this? Slide. Okay. One of the things I want you to think about in your business and in any other businesses that you look at, can you see arrows and stuff on this grid now? Somebody give me a thumbs up if you can see blue and red arrows. Okay, good. All right. One of the things I want you to think about is how money flows through your business. So many businesses and many people's personal financial life looks kind of like this model where money comes in the top in the form of income. It is used to pay expenses, and then whatever is left over is used to pay liabilities. So this is a case, let's say this is a personal finance example where we use a credit card to pay for our expenses, right? So this red arrow represents money coming from a liability like a credit card into pay expenses. And then of course that credit card generates an expense which has to be paid, from our original income down to pay off that credit card bill. Does that make sense to everybody? Yes. Okay. What I want you to start thinking about is all of the different ways that money can flow through your life and through your business. I mentioned that when we pay expenses, this money goes out of the business. These are not exactly to scale, but you might notice that there's a big amount of income coming in, which is then reduced to a much smaller amount of money that can go to cover liabilities, right? Because it filters through expenses first. And that, in theory, if you added the red arrow and the blue arrow, they kind of add up, minus a little bit of slippage, we'll just call it. Okay, so that's one way financials can flow. Another way financials can flow is we can have an income, we can have expenses, and we can use the leftover or our net income on a P&L to buy assets. Okay, now most of the time, this type of asset, the way I have it pictured here, again, the expenses leave the business and don't come back. These would be assets that you accumulate. In a personal finance situation, this might be an asset like, I'm just going to use gold as an example, right? Something relatively inert, doesn't produce any cash flow, may not produce any income, but also doesn't produce any expenses, right? It's pretty easy to keep, doesn't require much sort of care. Another example of how a business or your personal life can run is you can have assets that you own that ultimately generate income, which you use to pay expenses. Now, you can finance the purchase of those assets with liabilities, right? Those liabilities generate interest expense, for example. but those liabilities produce the cash that you can use to buy those assets to create income. Everybody get it? Does this kind of make sense? Generally, we can play this a million ways. I just want to walk through a few different examples. To sort of clarify this, what we often see is that a business is multiple pieces mixed together. Okay, so if we turned this into, or I want you to think about how to turn this into a farm or ranch example, but we have money from assets generating income. We have income being used to pay expenses. We have income being used ultimately to pay for liabilities. And then those liabilities, of course, generate additional expenses. Again, all of that expense money ultimately leaves the business, but then we also have some of these expenses that are required for the upkeep of assets. Gold, I mentioned, is like an inert asset. You could just have it on your desk. It could stay there and not really accrue any charges to it. If my asset is something like livestock, then I might have, let's say it's steer calves in a feedlot pen at somebody else's house. That asset requires a monthly payment to keep it fed and watered and all and cared for. So what I'd like to do here real quickly, we can do this in the chat again if you want, is I want you to turn this into a farm or a ranch example and come up with kind of a story of what's going on here. So I'll give you a couple of minutes to think about that, and let's have somebody raise their hand and walk us through an example where each of these arrows is tied to an activity that could happen on a ranch. This is where the Jeopardy theme song plays. I still have not downloaded that, so I can play that during these interludes. All right, let's start with this arrow right here. This blue arrow going from income to expenses. Who wants to give me an example of what that could be? On your ranch, what is that arrow? No guesses. George, am I asking this question reasonably, or is it hard to understand?
Seems reasonable. I don't know. I said lease payment. I don't know if that means I'm understanding.
That sounds great. Yeah. So if you lease land or rent land, right, you're going to use some of this income money to pay that lease. Perfect. Did you put that in the chat?
Yes, sir.
Bill Barnes did. I'm sorry. I took my eye off the chat for a minute. All right, fantastic. This big red arrow going out to the right. That also the leased money, right? When you use income to pay for the lease, that you don't get that money back, right? Okay, very good. How about this arrow, the big arrow here going from assets to income? What could that represent?
Livestock.
Okay, good. You own a herd of cows,
Yeah.
and once a year they bring you a calf crop. You own a flock of sheep. Once a year they bring you lambs. Okay, perfect. And that would go well again because there's like a maintenance cost that comes with owning that asset. What about if that's livestock, what would this arrow be here, Abe, in the same scenario?
Which one?
This littler blue one kind of on the bottom.
Oh, like your line of credit on them or your debt on them or whatever.
Yeah, I think that's one way to do it. This would be, let's say you bought stocker cattle, right? And this would be a relatively small line of credit against those stocker cattle. Yep. Awesome. Good. Or a revolving type loan even, right? Okay. And that then explains this other little red arrow here, which is the interest on that line of credit or revolving loan. Good. All right. I think the next slide. Yeah, good. Okay. Anything unclear about this model? Is there anything about this that's hard to understand? It's just a little clunky. But again, I think that it provides such a simple portrayal of a complete financial picture that it really helps me sort of understand a business. There are businesses with high debt and high assets and low income. There are businesses with high income and low assets. There, you could figure your business, a custom grazing enterprise here would look very, very different, right, than a wholly owned cow-calf operation that runs on owned land, and a cow-calf operation that ran on leased land would look very different. All right, one of the other things I want to make sure we leave with is the fact that when we pay expenses, so whether they are, this is a quick P&L here, and we're going to come back to P&L next week, but when we talk about our P&L, there is money or value produced at the top, okay? And then we pay direct costs and we pay overheads, and all of that leaves the business. This is the same P&L here put together on the left side. And again, I just want to emphasize the fact that when you pay expenses, that money leaves the business. When we get down here to our net income, that is the money that can flow onto our balance sheet. Okay, and so when we filter through all of this stuff that happens on the P&L, whatever is left over at the end has the opportunity in the form of retained earnings to flow onto our balance sheet. We can use that to reduce debt. We can use it to buy additional assets. We could just put it in the bank and leave it there. All right, so with that introduction, what I want to talk about is the balance sheet. And the reason why the balance sheet is important is because it's kind of the final place where everything lands. And when we look at our business over the long term, we really want a good concept for how things are going to ultimately land. All right, so you're asked your balance. Okay, first, before I move on to that, any questions about this part? And again, please feel free to stop me if you need. No questions. Either you're bored out of your mind, or I've explained it so perfectly you couldn't not understand. Or you can't figure out how to get the mute button shut off. Let's, good. Nothing in the check. Good. Nothing in the chat. Good. Monica, I missed your milk sales to purchase the dishwasher soap comment. That's a good one. That's perfect. All right, so our balance sheet is made up of a couple of main components. People differ slightly in how they construct a balance sheet. I am a simple, not very smart person, so I try to do assets and liabilities, and everything is either long-term or it's short-term. If you deal with farm credit and a lot of banks, they talk about intermediate-term assets. Those are things that are not short-term, but are on the shorter term of long-term. And then they'll have three classes, current or short-term, intermediate, and then long-term or fixed assets. And then the same on the liabilities side. The reason I break it into two categories is because to me, it's a simple division of this is either stuff I have to pay for this year, or it's stuff I'm paying for over multiple years. And for me, this year impact, the cash flow impact, is no different between a 5-year loan and a 30-year loan, other than I get to the end of the 5-year loan faster. But where we include a current portion on our balance sheets, that is the current portion of long-term debt in our current liabilities, for example, that sort of reduces everything down to that. It's either this year or it's the future. So current assets, who can give me some examples of those? You're welcome to talk or use the chat.
Operating loan.
Operating loan is a current liability, correct? Good, but it usually has to be paid every year. All right, good. Oh boy, we're typing fast here. All right, so cattle, perfect. So specifically, somebody else here said stocker cattle, which is slightly more correct. Grain inventory, that's a short-term asset. Feed, very good. Prepaid expenses, very good. All of those are current assets. Excellent. All right. What are long-term assets?
Land?
Yes, land is a long-term asset. Very good. What else? Don't be shy. Here we go. The fridge and the freezer. Correct, Monica. In which to put your milk and your soap. Put your soap on top and your milk inside. Good. Yeah. Okay, George. Cows you intend to keep, basically. Yep. Anything you depreciate. So that's good. And a breeding herd. Good. Those are all good answers. All right. And then again, as I mentioned before, the debt that goes with it, Abe, like you mentioned, the line of credit, the loan on stock or cattle, etc. We're gonna pair those things up kind of the same way, right? So your mortgage is a loan on a long-term asset that is also a long-term liability. The tractor loan is a long-term liability. The line of credit or the stock or cattle loan is a short-term liability. Again, I'm just going to mention, and we keep seeing it, and right now it makes me nervous. Please finance things with the appropriate financing. A lot of times your bank is going to say, oh, we'll just throw this on your line of credit and work it out later at the end of the year. I really don't like that. It's okay for a very short period of time, but if we're doing that for 6 months or so, that can become very uncomfortable if there are big changes in the market. The thing that scarred me about that, as someone who generally, I don't personally use a lot of credit, but we use some. But as I've seen more and more people use a lot more credit in 2021 and 2022, a lot of bankers were sort of putting people off, right? Oh, buy the corral materials on your line of credit, we'll finance it later. And then what happened is interest rates, doubled or tripled, depending on where you started. And things got a little tight and the banks got very uncomfortable with the refinance at that point. I want the refinance done now. It will be the same thing if you finance a bunch of cows that cost $3,000 right now. Put them on your line of credit and then try to refinance them. Let's just say at the end of the year, now cows have dropped by 50%. Your banker is going to be very uncomfortable moving that around. So please stay current on having the right financing. We can talk about that more later, but all right. Now, the one thing about the balance sheet that is a lot of fun to me is the balance sheet is basically a closed system, okay? Your P&L doesn't necessarily add up to anything, right? But the balance sheet, the fundamental accounting equation says that assets plus liabilities plus equity, or assets equals liabilities plus equity, right? Those things all have to equal out. So on my balance sheet, for example, I have cash in a bank account and I have liabilities. And so if I take cash out of that bank account and I pay a liability, I haven't really changed much. I've just changed the position. Okay. Same if I take cash out of the bank and buy an asset, I just am moving that cash asset around into different forms on the balance sheet. Okay. So think of the balance sheet like a closed system. We're trying to sort of trap value there. And we often wind up trading value between categories. So at any given time, we're taking a snapshot of where is the money tied up. Okay. If you are in a business that has inventory, for example, inventory really is money, but it's not money in cash form. So it's a slightly, in many cases, it's a slightly less liquid form of money, right? A liability is also money. It's just a future obligation, right? An IOU is almost as good as money, but nothing's as good as real money, right? So they all kind of have a little bit of a discount factor as you move away from cash in terms of liquidity, but ultimately you're trading one for the other. And I want you to be careful as you go into this and get more involved in your business. I want you to be thinking about how you move money between the different classes, how you move value between different classes. I was on a call this morning, kind of a neat deal with a guy who told a vague, a not too specific story about how when he was young, he got himself into trouble because he moved too many current assets into long-term assets too fast. Okay, current assets have the advantage of they generate income in the near term, right? Through their sale generally. When we move things to fixed assets, that you're going down a liquidity gradient, and so going from stocker cattle to breeding cattle, we want to be a little careful that we keep our ability to produce cash flow high so that we can service our expenses and our obligations. And so but there's a change as we do that, as we move things. So keep those types of things in mind. We'll come back to that more in the future. There are a couple of big things I want people to know how to do on their balance sheet. The first thing is I want them to know what their equity is. Equity is also described as your net worth. Equity is simply your total assets minus your total liabilities. So what is the sum total value of all the things you own minus the sum total value of all the things you owe? Okay, and when we talk about asset value here, we talk about a current fair market value, or FMV. You will see a tax balance sheet, for example, that is can be a very different number depending on your depreciation schedules. But when we're talking here, we're talking about fair market value. So if I sold the tractor, what would somebody give me for it? And then how much do I owe on it? So if I have a $150,000 tractor and I think I can sell it for that and I owe 100 on it, then my equity is going to be $50,000, the difference between what it's worth and what I owe. Does that make sense? Good. Okay. There's another one we want to pay attention to called our debt to asset ratio. This is a bit of a general number that depending on the business, we get into this in a couple of different ways, but lots of banks worry about this, which is again, how much do we owe compared to how much we own? It's another measure of that, same basic idea, except we do it as a fraction. So your equity is a number expressed in dollars. Your debt to asset ratio is a ratio. And so, if you have a 10% debt to asset ratio, you owe $10,000 on $100,000 in assets. Okay, that's a very comfortable place to be. There are other people, for example, that owe $100,000 and have $10,000 in assets. A credit card, as an example, let's say I've run up a credit card bill of $10,000 strictly on eating out. What is my debt to asset ratio if those are the only two pieces of the equation we're going to use? So if you're typing, I'll walk through it. I have accumulated literally $0 in assets, right? Eating out what I get is not an asset unless they give me like a cup at the end that I can take home. And I've spent $10,000 on that. So I have a debt to equity ratio that is infinite. Let's say it's very, very bad. Okay. Whereas if I have some cash in the bank and I use that I have 50,000 in the bank and I borrow 50,000 and I buy a herd of cattle that's worth $100,000, my debt to equity ratio would be 50%, right? I am 50% leveraged in that situation. Generally, when we have a debt to asset ratio that is very high, we are adding risk in our business. We're making it harder for that business to make a living. When that debt to asset ratio is very low, we tend to make it easier. But interestingly, sometimes there are some optimums that are not one end of the spectrum or the other. So just because you have zero debt does not mean you're sort of maximally performing in your business. Obviously, there's debate about that and how we handle debt. If we're at debt levels, depending on the type of asset also, on things like real estate, a banker will let you borrow a lot more against an asset like real estate because the values tend to be fairly stable. On stocker cattle, let's say you're trading, lightweight, high risk type cattle in southern Missouri. That's a much more volatile asset, both from a price standpoint and a production standpoint. We would want a lower debt to asset ratio there just because of the nature of that asset. And the last one that we spend a lot of time talking about is working capital. And this gives us a total idea of our liquidity. And there we just subtract current liabilities from current assets and come up with a measure of, where are we on a scale of being able to pay our bills throughout the course of a year. Most of you have heard me talk about working capital before. We usually scale this number into days. We're not going to get into that today. I just want you to understand the basics of working capital. Debt to asset ratio and working capital are often expressed in similar ideas that I don't believe are as good, which is why we use them. I'm not going to claim any real boundaries or rules on these necessarily. They really depend on the individual circumstance. Working capital is one that is often replaced by a current ratio or a quick ratio, where instead of subtracting those two numbers, you divide them. So you divide the current assets by the current liabilities, and you tend to look for a banker would like to see a bigger ratio there. The problem with the ratio, and frankly, the problem with subtraction sometimes is you have to pay attention to not just the ratio, but also the dollar value. So I think working capital is an older measure that kind of went out of style, but has come back in style because it really does tell you that the dollar number tells you a little more than the ratio does. There are multiple ways to have a really good working capital ratio, and some of them include situations that are not very good. So one of the things we want to make sure we do is put that dollar number in the perspective of what it costs to run your business. If I had $1 million working capital, that would be a pretty good number in my personal situation. But if Walmart had $1 million working capital, that would be a very bad situation. Brian Munger cited a statistic today that he got out of a book that we both read that I think it takes, I'm not going to be able to remember it. I wanted to say it takes $36 billion a year to run Walmart. Right. So $1 million is like a drop in the bucket. Doesn't even make a dent in that deal. Whereas for most of us that have businesses that cost, somewhere between $1,000 to $3,000 a day to operate, $1 million creates a really comfortable buffer. All right, let's walk through these in pieces. Any questions to this part? I'm going to go through examples from here forward. Nothing in the chat. If you guys see something in the chat, let me know about it. All right. So the first one we talked about was equity. If this is a balance sheet that I've just exported to Excel, so it's a little clunky looking. If you look at how a balance sheet is oriented when they come out of QuickBooks or most financial software, they don't present exactly the way Kiyosaki does. They present kind of all stacked on top of each other. So the assets are at the top, right? We start with current assets, and these go roughly in order of liquidity. So cash, the most liquid, and then inventory, which is pretty liquid, and then fixed assets, which are not very liquid or are less liquid. And we add all of those up and come up with our total assets. And then we take our liabilities and order them the same way. Okay, so most liquid to least liquid, current and fixed assets. And that gives us our total liabilities. Okay. And all we do in this case, we have $2.4 million. I forgot a comma there, didn't I? $2.4 million in total assets. We have $1.1 million in total liabilities. So we have an equity that is, about $1.3 million. One thing to notice, accounting software, because accountants are a special kind of nerd, we don't put the equity at the bottom of the balance sheet, which is something people sometimes miss. It is the second to last number. And really the last line is designed as a check Okay, so why would you add the assets plus the liabilities and the equity together? Why do you have this total liabilities and equity number? It's simply to make sure that the balance sheet balances. Okay, so it has to sort of all come down together. So I've had people get pretty excited because they see this number on the bottom and they think that's their equity, right? And that's a bit of a mistake. So please don't mistake the liabilities plus equity as your equity. Make sure you're looking at the total equity line. Any question about this calculation? This is like my kindergartner can do this subtraction pretty easy. Subtract one number from the other. Okay. We good there? All right. Real quickly, again, let's talk about the definition of equity. What does equity mean? And what do we want to be seeing over time?
Equity is the part that you actually own.
Yep. Okay. Good. It's what you own, often called your net worth. Good. What else? Yep. Bonnie, net worth. Good. It should be a rough approximation of if I sold out of this whole thing, sell off all the assets, pay off all the liabilities, it should be what's left over at the end, or at least an approximation of that. Does that make sense? So I've got a herd of cows, I've got land, I've got buildings, I've got horses, I've got equipment. If I sell all of those, pay off the debt, I would have about 1.3 million left over at the end. Okay. Want to make sure we really understand what equity is. Equity is not my ability to produce cash flow. Equity is not a measure of my self-worth. Equity is not, a whole bunch of things. It's just simply take the pile of assets, sell them off, pay off the liabilities, what's left over at the end. What do we want to see in terms of equity over time?
Grow.
We would like to see growth. That's exactly right. When we work in businesses that we own and we are able to generate profit and retain those profits in the business, our equity should be increasing through time. And if we think of our friend Wally Olson, what is he trying to do through the course of his career, but start with a very small equity, right? He started as a kid roping chickens in his dad's dairy. So that's even if you catch one, that's a pretty low equity start. Okay. And then ultimately through time, you want to grow your equity. And we are trying to grow. I would like to see people growing their equity through drought, through down markets, all that time. We want to be on a pretty consistent march there. Sometimes we don't necessarily worry about equity month to month, depending on our business. We really want to see this in an annual cycle. We want to check in on this annually, but we want to make sure the overall trend is in the right direction. Doesn't mean every year it's going up, okay? But we want to have it going in the right direction. And more than anything, we want to understand the factors in our business that drive our equity growth, and we want to be focused on those things. I am not a buy and hold type person generally. I want to be actively generating income from the assets that I own and using that to power the business. If you have land on your balance sheet over time, what tends to happen?
It gains in value.
Right. Does that help my case at all?
You should be gaining equity.
You do gain equity. Does that increase my ability to feed my family?
Not a bit.
Correct. So that's a place where we can grow through that type of appreciation, or we can grow through strong net income growth, which is then reinvested through retained earnings. Like I said, we often see people that get excited about the growth in their equity on their balance sheet, but they don't understand how or why it is growing. And it is very important that we dissect that we understand what it is that's driving our equity growth. And for me personally, I like that to be through things that increase my ability to feed my family, that increase my ability to care for my loved ones, that increase my ability to pass something on to the next generation. Does that make sense? Okay. I'll use this balance sheet to just point out that when I was a child, $1 million was really something. It isn't that much anymore. So while we always want to celebrate sort of numerical milestones, it's fun to set these goals out and say, I want to be worth $1 million. I want to be worth 5 million. I want to be worth 10 million. Just remember that inflation is something that is probably going to be driving your equity up over time. But you want to be growing significantly faster than inflation. And in many ways, we want to almost detrend this for inflation because that's what profit really does for us. Okay, next thing we talked about was debt to asset ratio. And so I'm going to just take the total liabilities. I should have written this out a little better. This total liabilities, which is the total amount of debt, and divide that by the total assets. And you can see how I've put this together. So we take the 1.1 in total liabilities and divide that by the 2.4 in total assets and come up with a number a little less than 50%. Again, what should your debt to asset ratio be? There are a lot of factors that go into this. Some of it is personal preference. Some of it is what type of asset, what type of business. Some of it includes what are the other options. So if you have a business that is heavily leveraged, but you also have a W-2 job that brings $1 million a year in, right? Your ability to service that debt is significantly aided by that $1 million a year W-2. Okay, so you might be able to tolerate a higher debt to asset ratio. If you are young and have no children, or maybe you're just starting out, you don't have much stuff, you might wind up kind of heavily leveraged, right? A new business doesn't have much generally in terms of assets and only starts with liabilities. New businesses are at high risk because they fail at a higher rate than established businesses, primarily because of that fact. They don't have much going for them in terms of either income potential or ability, or sort of assets in order to service liabilities. A lot of times if we're in something like a mortgage, as I mentioned, we can have a much higher debt to asset ratio. If we are in, high risk stocker cattle on the South Plains, we probably want to have a lower debt to asset ratio. When I look at these numbers, now's a good time to mention that I always look at these numbers in total. You can break it out, and say, well, this is the stocker cattle and this is the stocker cattle debt. I don't really care about any of that. I'm going to find the best deal I can on debt, and then we're going to use all of the assets to pay for it. So I don't want to collateralize all the assets with the bank. I want the collateralization to be correct, just as I want the mix of debts and assets correct. But I am not going to sort off these into we're not going to do enterprise level analysis on our debt. The debt is the whole business, and all of the assets combined. Any questions on debt to asset ratio? Again, the higher this number, generally the more risk. If you hold the asset class constant, let's say I'm borrowing money on cows. I went out last week and I bought myself some $5,400 pairs, and I financed them at 90%. Okay, so I've got $4,800, $4,900 in debt on those cows. How much risk am I taking? Stan, you got any ideas on that?
Well, you're potentially have a lot of risk.
Why?
Because if the cows devalue, or if you can't meet the cash flow interim, your risk is pretty high.
Yep. Okay. Does that make sense to everybody? Anybody ever had a cow die? It's happened to me once. It's very unpleasant, especially if you borrowed money on that cow. So I have to pay that money back, whether that cow is alive or dead, right? And if the market drops in half, I have to pay that money back. The banker doesn't give me any credit for the fact that her fair market value has changed, but my balance sheet will reflect that, right? So now if I am 10% leveraged on that $5,400 pair, okay, so I've got $5,400 in cow and I've got $540 in debt, my risk is lower for all of the reasons Stan mentioned, for all of the reasons I mentioned, but more than anything, the payment's easier to make. Okay, let's say that's a 5-year note. You know, silly numbers. That's $150 a year, let's say, that I'm going to pay for that cow. Well, I can probably make that work. And if I sell the cow, even if the market drops by 50%, I can still pay off the note. Does that make sense? Okay. When we think about debt, I want you to think very carefully about the fact that debt carries two types of risk. Okay. Debt carries a repayment risk, and debt carries a risk associated with the underlying value of the asset. The repayment risk is having, let's say it's a note on a cow, right? So I've got a 5-year note. That means I got to come up with, let's just say it's $500 a year to pay for that cow. Risk number one is actually being able to come up with that $500. Does that make sense? So it's the risk of me being able to make the payment. The lower that number, the lower the risk. Okay. The second risk is I have financed an asset that could change in value. Okay. And the risk there obviously is that the asset value goes down. Okay. So in the first case, I am relying on the annual income from that cow to pay the term note, right? To pay the annual note. In the second case, I would compare my ability to just sell the cow and liquidate the whole note. Does that make sense? So think of that as a stalker cattle example, right? When I take a loan on a stalker calf, unlike the cow, I get a calf, I sell the calf, I pay the note, but I still have the cow, right? A stalker calf, I sell the calf and pay the note with the proceeds of the calf. Okay, so think of those as two different types of risk, and every debt actually has those two risks in it, right? It just they just have different emphases, if you will, depending on the type of asset. Most of the time, I want to split those two risks. Okay, there are two sides to that risk. I'm going to try to only take one side. If I'm financing a cow, as an example, the cow can be the one that pays the note, meaning she generates the cash flow. She doesn't actually write the check. I get that. I have to be an intermediary. But the calf off of that cow is what pays the note. So ultimately, I'm the one responsible for paying it, but she's the source of the cash flow to pay the note. Okay. The other example is if, how do I protect myself from the underlying value change in the asset? That's a place where things like insurance, right? That's where LRP options, those sorts of things can help us, right? Because if the value of the asset changes, then now in the first case, if the cow is paying the cash, then I am still liable for the risk associated with the change in value of that cow or stalker calf. Does that make sense? But I would prefer not to sort of own or be responsible for both sides of that debt. I would like to split the risk, and I would like to give half to somebody else. And in this case, the somebody else is the cow. Does that make sense? Okay, so even if I am fairly leveraged but I can split the risk, I still am better off. All right, let's jump then into working capital. Working capital is very specific. It has nothing to do with your mortgage. It is only current assets, and this is very important. The last example is long-term assets and short-term assets, or current assets and fixed assets, okay? Working capital just deals with short-term assets. It is a measure of liquidity, okay? How effective are we at paying our bills? Working capital is a very easy calculation. We take the total current assets, we subtract the total current liabilities, and we come up with the difference. In this case, our total current assets are $800,000, 800 and change. Our total current liabilities are $470,000. This is not that subtraction at all, so please excuse me. So if we subtract 470 from 818, who can do that math quickly? Would be about 350. Does that make sense? 820 minus 470. Am I about right there, George? Brian's not here to check my math. Okay, so again, we come up with a working capital number in dollars. We then need to, I'm not going to go into this today, but we then scale that number based on the size and cash needs of our business. Okay. This is a very important number to pay attention to. Lots of important people in our world of ag finance have talked a lot about the impact of working capital. Your working capital too low is like driving around with your gas gauge just above empty where the light's on, right? It's flying your airplane over rough terrain very close to the ground. Working capital is a place where when you run out, your risk of hitting the ground is really high. And what we want to do is not hit the ground. This gives us resiliency more than anything, often gives us the ability to sleep better, often gives us the ability to make better decisions, and often gives us a lot of choice. People that are really good at finance, I think, often think in terms of freedom and choice. When you have a lot of cash or when you have a lot of working capital, you have a lot of freedom relative to not having it. So when really good opportunities present themselves, you can capitalize on those. There are limits. Do I think everybody should just keep all their cash on, keep everything in cash and keep it under your mattress? Like, no, that's a bad idea. But there's a balance point where you can have way too little. We have some stuff coming up that's pretty cool about how having, businesses that have reserves are more profitable. And if you look at some of the most profitable companies you've ever heard of, like Apple, they are famous for hoarding cash. Apple keeps an insane amount of cash on their balance sheet. And that gives them a tremendous amount of flexibility. As Bud used to say, very few people go broke with a lot of cash in the bank. Hard to do. Now, can you get crazy about that and hoard too much cash? Yeah, probably. And our productivity is contingent upon us taking the cash that we have and putting it into assets that generate more income. But most of the people I deal with do not keep enough cash. They do not have enough working capital. And that actually hampers the performance of their business. All right. Again, I want to go back to this idea of retained earnings as an opportunity to experience compound growth within your business. You guys are probably sick of me repeating this. I say this all the time. But when we are running our business correctly, when we are generating significant retained earnings, when we figure out how to reinvest those, our business does a much better job of working for us. Last month, Michaela gave a demonstration of her new dashboard tool. We are including a graph that looks similar to this for each of our customers' businesses at the end of the year that shows how their performance compares to investing. Many of us are familiar with the concept of opportunity cost. And in all of us in our business, this is the real opportunity cost, right? What is the cost of our current decisions in the future? Okay. And that is a very, very important thing to think about. I've used the example before. When I was young and stupid, I bought a very new truck. I bought a brand new truck. If instead of doing that, I invested that same money, and this would be, I was, I think 19, 20-ish at the time. So this would be, 30 plus years ago. That truck cost $13,500 at the time. I got a great deal. But what would that $13,000 be worth today? It would be worth a lot more than the truck, which funny enough was interestingly stolen right after I crossed 200,000 miles and took the comprehensive insurance off of it. So we know how that worked out. Anyway, if I had instead invested that money in a relatively low performing asset like the S&P 500, I would have a lot more than $13,000 now. If I had invested that in livestock the way we do currently, it would be worth significantly more than that. So I want all of us to be thinking with both a short-term perspective and a long-term perspective to the point that we, over time, are growing our equity so that it has a greater and greater ability to support us and then continue growing itself. Most people think of retirement as amassing a pile of cash into a 401k or an IRA or something like that, which they then draw, they retire, stop contributing, and then draw off of it, right? What we'd much rather have instead of a pile of something that we draw down as we live in retirement is instead, how are we producing a river of money that goes by so that we can take money out of it at whenever we need it, and it continues to come in from upstream. If we have assets upstream that generate good cash flow and are sufficiently large, they can both support us and support themselves, and often do so in such a way that they continue to grow. And that's the power of well-invested equity. All right, we're going to quit here. If you guys have questions, I am happy to take them. If you are bored of this and want to go do something else, I certainly support that too. So thank you very much for coming today. Hopefully this is helpful. Like I say, our next presentations, we are really going back to basics and trying to make sure that we cover the very, very fundamentals of finance that really we see driving people's performance forward in their businesses.
John, I have a question.
Hit me.
I was reading recently that if you hand a financial package to managers, they'll turn right to the P&L and start digging into it. If you hand it to bankers, they'll turn right to the balance sheet and really spend some time on it. Help me understand, because in these small businesses, we're kind of both. Help me understand the difference and the importance of those two.
Yeah, very good. So what is your banker most concerned with?
My repay.
Correct. And many of them are asset focused. And so that's why the manager, when you hand it to him, what is he focused on? What is his concern?
Probably turning money to generate his bonuses and all that kind of thing. So he's interested in short-term performance.
Yep, that's right. And so the operation of the business, right? The day-to-day operation of the business is largely a P&L activity, a profit and loss activity, whereas the investment and the overall long-term management of the business is a balance sheet. And this is a place where I think we actually get some of our performance metrics with some types of employees incorrect, because we keep them a little too P&L focused and don't keep them balance sheet focused. And I'll give you a quick example of this that was given to me by a guy that gave a presentation at the Wyoming Stock Growers years ago. He talked about making sure that, which has the greater potential for income, the appreciation value of the ranch or the daily, weekly operations of the livestock operation.
Livestock operation, the daily turn.
Well, maybe. But if you look at, just take the last 5 years and the appreciation that has happened in real estate, on a lot of ranch scale properties, right, that operate at scale to support a family, the appreciation there has been in the millions, right? Or at least in the hundreds of thousands, right? Whereas the profit generated from the livestock enterprise, in most cases, right, we know the average is actually not a positive number. But I would say that is often measured in the tens to hundreds of thousands, whereas the property appreciation is managed in hundreds of thousands to millions. Does that make sense? When we have a ranch manager, I want to make sure that they have an awareness and responsibility for both. Our job is to increase the value of the underlying assets and generate cash flow and retained earnings along the way. Does that make sense? So imagine a manager who generates a great P&L, and we see this in corporate America all the time, right? Generates a great P&L, but erodes the value of the asset. Right? We see this in the, the whole mergers and acquisitions process, venture capital, right? Famous for, coming into the company, basically dismantling it, selling off the most valuable parts and leaving kind of a burning wreckage behind. Okay. That's a place where we want to make sure we've incentivized our management level employees, especially at the level where they are responsible to generate good cash flow, good economic profitability, but also increase the value of the underlying asset. Most of us that are in regenerative agriculture take that for granted, right? Because our commitment to regenerative agriculture means that that's part of what we're thinking about. Now, some people, I'll claim, go too far in the fact that they stay too, I'm going to call it balance sheet focused, but they're too focused on long-term sustainability type things or environmental type things. And they're not nearly focused enough on the short-term, hey, we got to generate positive cash flow from this also. Does that make sense? So they ignore the finances and only look at their soil carbon accumulation, right? We've got a balance between the two of those. And again, I think good bankers look at both, but you're right. They absolutely are focused on the balance sheet. I think good managers do both, but yes, they're probably a lot more focused on the P&L. But we're generating that P&L within a context that drives us towards long-term performance. Many of you know, I worked for the LDS Church for a long time. A big part of their land management mission is long-term. They never talk about anything without talking about long-term. Burke Teichert is one of the architects of this system, right? As long as you have a long-term perspective in there, it prevents you from doing certain things, right? And again, that sort of burning down the factory while you're generating extreme profits in the short term is exactly what they're trying to prevent. We want the land, we want the buildings, we want the machinery, equipment, we want the people to all be getting better through time while we're generating positive cash flow. One of the guys that founded that company that's owned by the LDS Church was a wonderful, very, very smart guy who I got to spend a little bit of time with. And he used to talk about learning faster than inflation. And it was, again, a wonderful thought, right? And again, especially through the high inflation years that we've been through. But the huge difference maker in most businesses is, what does the owner know, right? What do the managers know? And how do we convert that into profitability that grows faster than inflation, into equity growth that grows faster than inflation? All of our costs have gone up a tremendous amount in the last few years. Are we actually better to where that's not a threat to our existence? Does that kind of answer your question? Okay. The third report that I didn't really talk about today, that we're going to talk about a lot more also as we go forward, is the cash flow. And lots of times I'm even to the point where I think that's more important than the P&L. The P&L I prefer as a leading indicator, but we've really got to be paying attention to cash. Often you have to produce economic value before you get to cash, right? You produce the value and then you convert it to cash. So like I say, a P&L can be a leading indicator, but it isn't always. And we need to be much more explicit about that fact of how we see that cash turn in, how we use it, how we generate it first, and then how we use it to improve the business. Good question. As the owner, I really think you need to become balanced. You need all three. As a brand new business owner, you're probably pretty P&L focused because you've got to get this thing up and going. As a much older business owner, you're, owner of an older business, if you will, you're probably more balance sheet focused, right? Because you probably already have cash reserves. You've already got big piles of assets. You've got lots of resiliency built in. Cool. What else? Quiet crowd today.
With cash flow, how do you think about projecting cash flow? And
great question.
you know, I don't personally don't really do it that well or at all. I mean, I do
Yep.
on paper, notepad, whatever, but just
Yeah, I think one of the reasons let me give you some reasons and then we'll talk about the how. So predicting cash flow is guessing, right? In the extremist form, the most extreme form, right? One of the things that's super important with it is you have to understand that most businesses don't go broke or don't go out of business because they're not profitable. They go out of business because they run out of cash. And I have seen multiple examples of that up close. Cash, when I was young, managing cash became my most important thing because of seeing exactly that. I'm going to use a birth to plate direct consumer type model as the first example, right? Let's say it takes me 30 months to grow a calf to slaughter from birth. Okay. That now add 9 months of pregnancy on that cow, and then add a year and a half, 2 years of developing that cow from a calf herself. Okay. That's an incredibly long cycle to get to a product that now I could sell to a customer if I had that customer. And let's say it takes me another 6 months to actually get it all sold. I holding my breath for that long, I have bills to pay that whole time, right? But I don't have any cash income. When you have to hold your breath that long, you're taking a lot of risk through that period. And the biggest risk is you can't keep paying into this thing without running out of money. Okay. That's a very extreme example in our industry. But again, think of guys that grow pecans, right? It's 7 years from the time you put the little tree in the ground until you have any kind of harvest, as I understand it. I'm no expert in pecans, but you have to grow a tree first, right? And then that tree produces fruit. It's the same with apple orchards, all kinds of things. It's a long turnaround time. The way we project cash flow is simply, estimating what I prefer monthly for most businesses. Some need to operate weekly. But oftentimes we can guess at what our sales are going to be and when they're going to come. And we do that on like a 12 or 16 month type calendar. And then we can guess what our expenses are. The expenses are often the easier part because there are whole classes of our expenses that are kind of fixed, right? My phone bill, for example, doesn't change from one month to the next. It's the same month after month. Anything like that that's fixed, I can sort of lay out, okay, it takes me X number of dollars per month just to cover these costs. All right. And then if I buy some calves and want to feed them, well, okay, I buy $100,000 worth of calves and I have to buy $20,000 worth of feed to go with them, right? To feed them. So again, we try to lay that out. And then what I've gotten a lot more aggressive about here lately is making sure that when we make a 12-month plan, we don't get stuck in it, but that we come back in the next month and revise it and look again 12 or, either 4, 12 or 16 months in the future, kind of depending on the business. But that as, okay, so I think that in July, we're going to sell 400-pound calves for X dollars per head. Great. I'm going to make an estimate. Well, once I get to July and I actually sell those calves, I'm going to revise that number. Let's say I contract them in July for fall delivery. Well, now I'm going to revise that number because I have a much better idea of what they're going to bring. Okay. That gives me a better picture of the future. So as we go forward in time, that projection needs to be constantly updated with current conditions, because usually when we forecast, we're better at forecasting something that is going to happen tomorrow, right? So here's an example. We sold some cows today. Okay. Pretty good idea. Right now, I could guess what they sold for. Is that fair? Okay. If we were selling them tomorrow, also pretty good idea. I could ballpark what those cows are going to bring tomorrow. A month from now, I've got a reasonable guess, but a lot can happen in a month. 6 months from now, 12 months from now, 18 months from now, 36 months from now, right? My guesses get worse and worse. I might plug the same number in each time, but the confidence interval on the thing, right, gets huge. I could guess $1,800 16 months from now, and they could be $5,400. They could be $800, right? The spread gets bigger and bigger as you go forth in time. So what I want to do is continue revising those estimates as my information gets better. And like I say, often there's a sweet spot between 4 months and 16 months where I can make a reasonable guess and then I can keep updating it to keep myself from crashing into the ground. This also depends a little on how much reserves a person likes to keep. People that keep bigger reserves or have access to other, sources of capital can get away with less cash flow planning or less stringent cash flow planning, right? Whereas people that are operating on a razor thin margin, like we often are in a very young business, right? They have to be a lot more careful because a small stumble can be a big problem. If I have $30,000 a month in payroll and I have 150 or 350,000 in the bank, I'm not that worried about the next month or two, right? I'm probably going to be able to make payroll. But if I have 30,000 in payroll and I have to sell milk by the gallon to get there, and I don't have any money, I have to sell it in the next 30 days in order to make my next payroll, I'm going to be a lot more worried about that. Does that make sense? So if it costs me $2,000 a month to operate the ranch and I have 100,000 in the bank, I can be pretty sloppy. I still don't advocate not having a cash flow, but it's going to be a long time before problems really surface. If I've got $2,000 a day expenses and $30,000 in the bank, and that's my only source of paying those bills, I need to be making a plan as early as possible. The thing that's beautiful about forecasts is it allows us to see problems coming. All of the financials that we do, that we generate out of QuickBooks, are all past, right? They're all history. So we could say they're all irrelevant. We know that's not exactly right, but that is the past. When we look to the future, what we need to be able to do is project accurately enough that we have an idea of where potential problems are going to come from and what we can do about them, or where potential opportunities are going to come and what we can do about them. And if we keep that future focus, we really can start to see things as, problems before they become problems. So I don't know if that answers your question, Abe. Is that in the ballpark?
Yeah, I think so. I mean, just, sometimes the cash flow is only coming a couple times a year. And,
yes.
Yeah.
The good thing about those is those are easy cash flows to do, right? Okay, we have income twice a year. Fill that in 2 spots. Call it good.
Yeah.
Right? But that from the income that you do get, let's say you sell calves in November, and that's your income for the next, that's your next sale doesn't come until next year in September. You can make a plan that says, all right, I've got, I just sold 100,000 in calves. That's what's got to sustain me all the way through. And knowing what your costs are each month will really help you plan that out, know how much you need for a line of credit, that sort of thing.
Right.
Cool. Good. Other questions? Very good. Well, then we'll wrap up. Nice to see all of you. Thank you very much for coming. Thank you for staying. Thank you for asking questions. Like I mentioned, we're going to keep kind of going through this Back to the Basics series and really try to make sure that we've got the foundation that we need to be successful in our business. So look forward to seeing you again in a month. I feel like I have a couple of quick announcements I should make. One, if you're not aware, FYI is doing a Monday morning Market Pulse call. It's been very well attended and a lot of fun. We are moving in June. We're doing an open finance Q&A hour on FYI also, that is not structured as a presentation. It's just literally, bring whatever questions you have. That has been Thursday mornings at I think 11 or 10. That is moving in June to Thursday mornings at 6:30 a.m. Mountain Time. So we need to get a few more people in that discussion if we're going to continue doing that. We've had some cool episodes on Ranchonomics lately. And one really cool one, if you listen to the Ranching Returns podcast, Jared did an awesome interview with Alex McKiernan, who's somebody that we had on our podcast, where they actually talk about their business and that sort of thing, what those guys do. Alex and Chloe are friends of mine, super good people. And it was a really cool podcast. Jared did a really nice job with that. So look those
Alex,
things to listen to. What'd you say?
I said Alex was at our table at Ranching for Profit. So we kind of
good. Did he cheat there too?
Okay. I don't know.
Good. Awesome.
I think we've been through it before. So
very good. Very good. This webinar and all of our other webinars are available on YouTube, and it would be awesome if people would subscribe to our YouTube channel. We have a Ranch Right LLC YouTube channel. It is linked on our website. But if you're on there, then anytime a video updates and you subscribe to that, you'll get an update. So subscribe to YouTube, subscribe to the podcast, and keep coming back. So thanks. Great to see all of you.
Really good job, John.
Thank you. Appreciate it, Stan.
Okay.
Have a great afternoon. Are you must be doing deliveries or something? Running errands.
I am.
Good.
I like it. I'm not available for interruption. I can get
what
a lot
you have
of
to do
phone
is
calls.
hide out in your truck in town, huh?
Yeah. It's a productive day, believe it or not.
In the yard, huh?
Yeah. No, I'm in town. All right.
Very good.
See you soon.
You bet. You too. Jennifer, good luck with your finishing up your greenhouse season. I'm anxious to see the total. Cole gave me kind of a preview the other day, so I'm really looking forward to seeing more. Very good. Good to see you, George. Tell Lisa I said hi.
Will do. Thank you. Take care.
You bet. Thanks, Abe, for coming. Appreciate it. Are you getting rain up there, Abe? Are you guys in the dry part or the wet part?
It's raining. It's been raining all day. So.
Good. That's what we've had. Been wonderful.
Yeah.
The 40 degrees is a little rough, but we'll take it. Cool.
Yeah.
All right. Have a wonderful afternoon. Thanks, man.
Thank you.
Yeah, see ya.